February 1, 1995. The Real Estate Capital Scoreboard. February 1995. Accrual debt, mini-perm, is popular for acquisition financing, renovation, construction and other high-leverage fundings in excess of 75% loan-to-values with provable cash flow upside. Current pricing ranges from 1.5% to 2.5% floating over bank prime. Typical term is 5 to 7 years. Standby commitments are also attractive funding alternatives. Standby fees start at 1% per 6-month period plus a 50% or greater ownership right for providing credit enhancements. Key sources for accrual loans include credit companies, select banks and private placement funds. Expect accrual loans to gain popularity as more development deals emerge based on supply-constrained markets. April 1, 1995. The Real Estate Capital Scoreboard. April 1995. New construction activity is slowly re-emerging. Borrowers are seeking high-leverage funding options to launch such projects. Popular high-leverage funding options evolve around hybrid, debt/equity, loans. Most transactions involve debt. Convertible/participating mortgages and joint ventures are preferred. Hybrid loans are structured with 8% to 9.5% coupon rates with 20% to 50% equity and reversion participation. Combined leverage ranges 85% to 95%. Overall yields, for example, IRR, range with 10% to 15%, assuming 3 to 15 years holding periods.
May 1, 1995. The Real Estate Capital Scoreboard. May 1995. Rates dipped to their lowest levels of the year, ranging from 50 to 75 basis points lower than last month. The spread between short and longer-term financing is widening as the yield curve is no longer flat as was the case earlier in the year. A new rule of thumb: 5, 7 and 10-year mortgage term differentials increase in increments of 0.1%. In fact, rates below 8% are now available, reflecting the end of the rate range. Life companies and pension funds cover the highest quality, long-term debt markets. However, mortgage conduits and banks are aggressively gaining ground for short-term and more creative transactions. June 1, 1995. The Real Estate Capital Scoreboard. June 1995. Debt markets are on a steady course with limited changes. The equity markets are gaining momentum. Capitalization rates and overall yields are represented by the following ranges. Multifamily -7.5% to 9% going-in yield, 11% to 14% overall yield. Retail/shopping centers -8.5% to 11%, 10% to 14% overall. Office -7% to 12%, 10% to 15% overall. Industrial -8% to 11%, 11% to 14% overall. Lodging -8% to 15%, 11% plus overall. Virtually every type of income-producing real estate is capturing attention. The buyer's market that dominated the earlier part of this decade is rapidly transforming into a seller's market. Well-located properties with reasonably predictable cash flow are in high demand. July 1, 1995 The Real Estate Capital Scoreboard July, 1995. Rates have been steady, moving slightly downward since June. Due to lower rates, lenders are busy processing a record number of loans. The result, timing is a key issue for funding the loans in today's marketplace. August 1, 1995 The Real Estate Capital Scoreboard August, 1995. Since the beginning of summer, rates climbed by about 25 basis points. Current permanent mortgage rates start at about 7.25% for a 10-year term. Equity markets remain constant with 7.5% capitalization rates as starting points for most institutional quality multifamily properties, 8.5% for commercial properties with net lease, retail, industrial and office properties ranked in order of favor. Lenders are keeping busy as a steady stream of refinancings and new acquisitions fill production volume quotas. September 1, 1995 The Real Estate Capital Scoreboard September, 1995. Virtually no change in rates since August. With the summer holidays concluding, significant loan volume increases are predicted for the remainder of the year as borrowers take advantage of favorable rates. In general, short-term interest rates start at 7.25%, with medium and long-term rates approaching 7.5% or more. Capitalization rates ranges start at 7.5% for multifamily deals and 9% for lodging properties. Overall internal rate of return start at 10%. October 1, 1995 The Real Estate Capital Scoreboard October, 1995. Mortgage rates barely decreased by about 0.1% throughout the past month. The interest rate spreads over treasuries remained unchanged. Generally speaking, the following treasuries rates apply, depending upon project location, quality, age, and economic performance. Class A, long-term net lease, new and highest quality start at 100 to 140 basis points. Class B, excellent with strong history start at 140 basis points to as much as 200 basis points. Class C, reflecting older, more management-intensive properties start at 200 basis points to as much as 350 basis points. November 1, 1995 The Real Estate Capital Scoreboard November, 1995. For a third month in a row, mortgage rates slightly dipped by about 0.1%. In addition, Treasury pricing spreads remain unchanged. Class A pricing starts at 100 basis points over Treasuries, with Class C properties taking as much as 350 basis points. December 1, 1995 The Real Estate Capital Scoreboard December, 1995. Many lenders and buyers are over-allocated with retail properties, with industrial properties ranking as one of the more favored asset classes below multifamily deals. Capitalization rates start at 7% for multifamily and 8% or more for other Class A income-producing assets. All in all, rates remained virtually unchanged since November. Although rates are at historic lows, many lenders are establishing floor limits, with 7% serving as a popular benchmark.